The greatest lie society ever forced into your brain is that trading your time for a steady paycheck is the ultimate path to freedom. The terrifying truth is that you are sacrificing your vital energy and your fleeting youth for 8 to 10 hours every single day, building a spectacular financial empire for massive institutions while your own foundation crumbles into dust. You are running on a treadmill that is slowly increasing its speed, while the incline gets steeper and steeper, and yet you are wearing a blindfold, completely unaware that you are sprinting directly toward a financial cliff. This is not a scene from a dystopian science fiction movie. This is the absolute terrifying reality for millions of hardworking individuals who have been sold a massive, perfectly orchestrated lie about how to build wealth in the modern world. They are heavily conditioned by society to buy the newest titanium smartphone, to finance the rapidly depreciating luxury car to impress people they do not even like, and then, with whatever pathetic pennies are left over at the end of the month, they throw them blindly into the stock market or the latest speculative cryptocurrency craze, praying for a miracle. They are attempting to construct a spectacular, gleaming, 100-story skyscraper on a foundation made entirely of wet sand and high-interest credit card debt. And then they wonder, with genuine confusion and profound frustration, why their entire financial structure collapses into dust every single time the economic wind blows. Welcome to the Great Financial Awakening. My name is Nick, and today, we are not just going to talk about money in the traditional, boring sense. We are going to completely deconstruct the matrix of modern personal finance. We are going to permanently rip out the bad wiring that consumer culture has forcefully installed in your brain, and we are going to replace it with a cold, hard, mathematically bulletproof sequence of operations. This is not a conversation about getting rich quick. Getting rich quick is a predatory marketing gimmick designed exclusively to separate impatient fools from their capital. True wealth, lasting generational wealth, the specific kind of wealth that allows you to sleep peacefully at night while the rest of the world panics during a recession, is built through absolute, relentless architectural precision. You must understand a fundamental law of the universe. Doing the right financial move at the wrong time is exactly the same as doing the wrong move entirely. Timing and sequence are absolutely everything. If you are someone who is finally ready to stop bleeding money, ready to stop making banking executives richer, and ready to graduate from a financial amateur to a highly strategic wealth architect, make sure you hit that subscribe button right now. Listen incredibly closely to every single word in this masterclass, because the sequence of operations I am about to reveal will literally save you tens of thousands, if not hundreds of thousands, of dollars over the course of your lifetime. Let us begin at the absolute bottom, the bedrock upon which all empires are built. To understand the very first step in our impenetrable sequence, we must first dive deep into human psychology and the neuroscience of stress. Traditional financial advisors lazily call this first step the emergency fund. But I completely reject that terminology. Calling it an emergency fund implies that you are a victim, just sitting around waiting for something terrible and unpredictable to ruin your day. Instead, I want you to completely conceptualize this money as your psychological safety net. It is your ultimate financial armor. It is your barrier against the chaos of the universe. According to devastatingly accurate recent economic data, over half of the population cannot even cover a basic $1,000 emergency using their savings. $1,000. That is mathematically less than a standard monthly payment for a depreciating automobile or a minor medical bill. Yet, these exact same individuals will confidently slide into my comments section and ask me if they should be buying volatile technology stocks or leveraging their money in speculative digital assets. It is a complete and utter detachment from mathematical reality. Before you even think about opening a brokerage account, before you dare to invest a single dollar in the global markets, you must aggressively build your psychological safety net. Why is this so profoundly critical? Because we must look at how the human brain operates under financial duress. When you do not have a cash buffer, every minor inconvenience in life immediately escalates into a full-blown financial catastrophe. When the transmission in your vehicle inevitably fails, or when a sudden medical bill arrives in the mail, the severe lack of available cash forces your brain into a biological state of panic. The amygdala fires, cortisol floods your system, and in this heightened state of panic, your brain literally shuts down its prefrontal cortex, which is the area responsible for long-term planning and logical reasoning. You are biologically forced to make terrible, destructive, short-term decisions. You end up panic selling your carefully chosen investments at the absolute bottom of a market crash, thereby locking in permanent, devastating losses. Or even worse, you finance your basic survival on high-interest credit cards, trapping yourself in a suffocating cycle of compounding debt. The true enlightenment here is recognizing that your safety net does not just protect your daily life, it actively protects your investments from your own emotional reactions. So, what is the exact step-by-step execution strategy for building this armor? The generic, watered-down advice is to save 3 to 6 months of living expenses, but that is far too vague for a wealth architect. We demand precision. Step 1 is to violently save your first $1,000. I use the word violently on purpose. You must attack this goal. Sell things you do not need, work extra hours, cancel every single subscription you possess, do whatever it takes legally and ethically to get that first $1,000 safely into the bank. This immediate action separates you from the absolute edge of the cliff. Once you achieve that initial milestone, you systematically and methodically build it to 1 full month of absolute bare-bones living expenses. Then, you stretch that horizon to 3 full months. If you are a freelancer, an entrepreneur, or if you work in a highly volatile industry with high turnover, you must keep going until you hit 6 months or even a full year of expenses. And here is the most crucial part that amateurs miss. This money absolutely cannot sit in a traditional brick-and-mortar bank earning a pathetic 0.01% interest. That is financial negligence. You are losing purchasing power to inflation every single second. You must place this safety net into a Federal Deposit Insurance Corporation insured high-yield savings account. In the current economic climate, these specific accounts can pay around 4% interest annually just for letting your capital sit there in absolute safety. It remains completely liquid, it is entirely secure, and it acts as an invisible, impenetrable shield around your entire financial empire, generating free cash flow while you sleep. Moving forward to the second phase of our masterclass, we must address the absolute cancer of wealth building. I am talking about high-interest debt. Once your basic psychological safety net is firmly in place, every single aggressive dollar you generate above your living expenses must be deployed as a weapon to destroy bad debt. When I use the term high interest, I am specifically referring to any financial obligation charging you more than roughly 8% annually. Credit card debt is the ultimate, undisputed villain in this story. It is the greatest wealth destroyer ever invented by modern financial institutions. With average interest rates currently soaring well over 22%, carrying credit card balances from month to month is a mathematical catastrophe of epic proportions. Let me give you a profound realization that will change how you view the world. People who invest in the stock market hoping for an optimistic 10% annual return while simultaneously paying 22% interest on their credit cards simply do not understand basic arithmetic. They are fighting a war on 2 fronts and mathematically guaranteeing their own defeat. Let us break this down into a terrifying, real-world perspective. If you hold exactly $5,000 in credit card debt at a 22% interest rate, and you fall into the psychological trap of only making the minimum payments required by the bank, you will bleed out nearly $2,800 in pure interest over the next 5 years. That is money stolen directly from your future self. Every single dollar you use to pay down that specific high-interest debt is mathematically identical to earning a guaranteed, risk-free 22% return on an investment, and it is completely tax-free. Let me repeat that because it is vital. Paying off 22% debt is exactly the same as finding an investment that guarantees a 22% return. Even the legendary investor Warren Buffett cannot guarantee you a 22% annual return year after year, but paying off your credit card absolutely does. Now, how do we execute this destruction phase efficiently? You have likely heard of the popular debt snowball method, popularized by mainstream financial entertainers, where you pay off the smallest account balances first purely to gain psychological momentum. You have also likely heard of the debt avalanche method, where you mathematically attack the highest interest rate percentage first. But as an advanced wealth architect, let me introduce you to a more sophisticated enlightenment. I call it the absolute dollar drain strategy. You should take a spreadsheet, list every debt, and multiply your total balance by the specific interest rate to see exactly which debt is costing you the highest absolute dollar amount every single month. A massive student loan at 6% might actually be draining more physical cash from your daily life than a tiny credit card balance at 24%. You must attack the debt that is draining the most actual physical cash flow from your existence. This hybrid approach beautifully combines mathematical efficiency with undeniable, immediate psychological relief to your monthly budget. However, as with all complex systems, there is one massive, glaring exception to the strict rule of paying off all debt before investing. This exception is so incredibly powerful and mathematically undeniable that it actually overrides the debt destruction phase entirely. This brings us to phase 3, the phenomenon of the employer match. If your current company or corporation offers a matching contribution to your retirement plan, usually in the form of a 401k, you must contribute exactly enough to capture that full match, even if you are still actively fighting high-interest credit card debt. I know this concept seems completely counterintuitive at first glance. Why on earth would you invest money in the stock market when you owe a bank money at 22% interest? The answer lies in the sheer, unadulterated power of free capital. Employer matching is essentially a guaranteed 100% return on your investment, conjured up out of thin air by your human resources department. Imagine walking down the street and finding a magical machine that promises to hand you $2 tomorrow for every one single dollar you insert today. You would put every dollar you could find into that machine. That is exactly what an employer match represents. For a mathematical example, if you earn $50,000 a year and your employer matches 50 cents on the dollar up to 6% of your salary, contributing $3,000 of your own money instantly unlocks a $1,500 bonus from the company. That is an immediate, mathematically guaranteed 50% risk-free return before the stock market even opens for trading. Absolutely no mutual fund, no brilliant real estate syndication deal, and no speculative cryptocurrency token can ever promise you a guaranteed, immediate 50 to 100% return with zero market risk. The strategic move here must be absolutely surgical. You contribute precisely the minimum amount required to extract the maximum match from your employer. You do not contribute a single penny more at this stage. Once you successfully capture that free money, you immediately redirect all of your remaining free cash flow right back into destroying your high-interest debt from phase 2. However, you must also pay incredibly close attention to your company vesting schedule. A vesting schedule is a corporate mechanism that dictates exactly how long you must remain employed at that specific company to actually keep those matching funds. Some companies use a cliff vesting schedule where you get nothing if you leave before 3 years, and then you get 100% on day 1 of year 4. Others use a graded schedule where you earn 20% of the money each year over 5 years. Even if you passionately hate your job and plan to leave, the mathematical probability usually favors taking the match, but you must read the fine print in your benefits package. Doing this unsexy, boring administrative work right now is exactly what makes your future look luxurious and effortless later in life. Once your safety net is fully funded, your toxic, high-interest debt is completely eradicated, and you are surgically capturing every penny of your employer match, we confidently enter phase 4. I call this the tax optimization zone. This is the exact threshold where ordinary, average investors graduate to become sophisticated financial architects. Your next mandatory step is to maximize your individual retirement account, commonly known as an IRA. Why do we heavily prioritize the IRA over putting extra, unmatched money into the corporate 401k plan? The answer comes down to 2 absolute pillars of wealth building: ultimate control and the destruction of hidden expenses. Corporate retirement plans are globally notorious for offering a highly restricted, heavily curated menu of mutual funds. These funds are often saddled with ridiculous administrative fees and exorbitant expense ratios that quietly and maliciously drain your wealth from the inside out. A management fee of 1% might sound completely harmless to an amateur. But when that 1% is compounded over 30 or 40 years of investing, that single percentage point can easily devour tens of thousands or even hundreds of thousands of dollars of your potential future wealth. It is literally the difference between you keeping your hard-earned money or using your money to unknowingly finance a luxury yacht for a Wall Street fund manager who does not even know your name. By opening your own completely independent IRA at a major, reputable discount brokerage, you instantly gain complete, total control over your destiny. You can bypass the expensive mutual funds and directly invest in broad market index funds and exchange-traded funds that charge mere fractions of a basis point. We are talking about practically zero fees. Now, once you open this account, you face the classic, eternal financial dilemma. Should you choose a traditional IRA or a Roth IRA? The enlightenment here requires deeply analyzing your current life phase and predicting the macroeconomic future of government taxation. A traditional account gives you a strict tax deduction today, meaning it lowers your current tax bill, but you will absolutely pay income taxes when you withdraw the money in your retirement years. A Roth account is the exact opposite. It requires you to pay taxes on the money today, taking the pain up front, but the capital grows completely tax-free, and you withdraw the millions of dollars tax-free forever. The general mathematical rule of thumb is that if you are young, starting your career, or currently sitting in a low tax bracket, the Roth account is your absolute best friend. This is because your personal tax rate, and likely the government tax rates overall, will likely be much higher in the future. You lock in the low rate today. Conversely, if you are an older professional in your peak earning years, making a massive six-figure salary, the traditional account helps powerfully shield your current high income from heavy government taxation today. But here is an incredibly advanced, master-level strategy that almost everyone completely overlooks, especially parents. If you have teenage children who will be actively applying for college financial aid in the next 2 to 3 years, strategically contributing heavy amounts to a traditional retirement account actively and legally reduces your adjusted gross income on your tax returns. This legal reduction in your visible, taxable income can significantly and sometimes drastically improve your family eligibility for financial assistance, grants, and favorable loans when filling out the free application for federal student aid in America. This is exactly how the truly wealthy use the complex tax code not as a burden, but as a strategic weapon to their ultimate advantage. After fully optimizing and maxing out your IRA contributions, we arrive at Phase 5. This is what I consider to be the ultimate, undisputed secret weapon in modern personal finance. If you happen to be enrolled in a high-deductible health plan, you are legally granted access to a health savings account, commonly abbreviated as an HSA. Most average citizens treat the HSA exactly like a simple, low-yield checking account. They put a few $100s in it, and then they immediately use that money to buy minor bandages, prescription medications, or to pay for a standard doctor copay. This is a tragic, monumental waste of mathematical potential. The HSA is the single, solitary investment vehicle in the entire American financial system that offers a profound triple tax advantage. It is the holy grail of financial accounts. Let me break down the absolute magic of this structure. First, the money you contribute into the account is completely tax deductible, legally lowering your current income tax bill immediately. Second, the money inside the account does not just have to sit in cash. You can and must invest it in the stock market, where it grows completely tax-free, exactly like a standard retirement account. Third, and this is the absolute kicker, any withdrawals you make for qualified medical expenses are completely tax-free. The money goes in untaxed, it compounds over decades untaxed, and it comes out untaxed. It completely defies the normal, oppressive laws of the Internal Revenue Service. But here is the profound, mind-bending strategy that will completely change your financial trajectory. The absolute smartest, most aggressive way to use an HSA is to mentally divide it into a cash side and an investment side. You must invest the vast majority of the funds inside the HSA aggressively in the global stock market to let the mathematical miracle of compounding do its work over decades. When you inevitably incur a medical expense today, like a dental procedure or a hospital visit, do absolutely not pay for it using the funds inside the HSA. Instead, pay for it out of your regular monthly cash flow or put it on a rewards credit card that you pay off immediately in full to capture the travel points. Then, you simply save the receipt in a secure digital folder. Why? Because currently, under the law, there is absolutely zero time limit on when you can reimburse yourself for a qualified medical expense. You could theoretically have a major knee surgery today, pay out of pocket, let your HSA money grow exponentially in the stock market for 25 years, and then a quarter of a century later, hand the government that 25-year-old receipt to instantly withdraw those funds completely tax-free to buy a boat or go on a luxury vacation. Furthermore, the magic does not stop there. Once you reach the age of 65, the HSA fundamentally transforms. At that age, you are legally allowed to withdraw the money for any non-medical expense whatsoever, paying only normal income tax on the withdrawal, which makes it function exactly like a traditional IRA. But given the terrifying statistical reality that the average retired couple in the modern world will spend hundreds of thousands of dollars on healthcare during their retirement years, having a massive, compounding, tax-free war chest specifically designated for medical costs is a phenomenal, unmatched layer of security. It turns a massive retirement liability into an absolute non-issue. If you possess the incredible discipline to have successfully maxed out your independent IRA and fully weaponized your HSA, your next strategic maneuver in Phase 6 is to circle all the way back to your employer 401k plan. Now, you aggressively fund it far beyond the initial match, pushing it all the way up to the absolute maximum legal limit allowed by the government. For the current calendar year, this means aggressively pushing around $24,000 of your own capital into the account, or well over $30,000 if you qualify for age-based catch-up contributions. Let us pause and do the math on the empire you are building. By mathematically combining the maxed-out IRA, the fully funded HSA, and the maximized 401k, a disciplined, aggressive investor can literally shield over $35,000 from government taxation in a single calendar year. Let that profound reality sink in for a moment. You are legally, ethically, and strategically hiding tens of thousands of dollars from the taxman every single year, and you are allowing that massive pile of capital to compound aggressively in the global economy, completely untouched by the drag of annual taxes. I must be brutally honest with you at this specific juncture in the masterclass. The vast, overwhelming majority of human beings will never, ever reach this step. The average citizen saves a pathetic 4% of their total income, which barely covers the initial employer match, let alone funding secondary and tertiary accounts. But if you are one of the rare individuals who has relentlessly restructured your lifestyle, violently controlled your impulse spending, avoided the deadly trap of lifestyle creep, and actively elevated your income to reach this phase, you are currently operating in the top 5% of wealth builders on the planet. You are demonstrating the exact, cold, calculated financial discipline that builds untouchable generational wealth. You are no longer acting like a gambler, chasing shiny objects and hot stock tips. You are systematically constructing an indestructible financial fortress. Every single step you have taken so far meticulously builds upon the foundation of the last. Your psychological safety net acts as the deep, uncrossable moat, preventing unexpected disasters from breaching your castle walls. Your aggressive debt eradication ensures that no parasitic enemies are quietly draining your precious resources from the inside. Your employer match is the free labor building your tower higher. And your highly optimized, tax-advantaged accounts are the impenetrable, vaulted safes keeping the government hands completely off your gold. Only after you have completely and utterly exhausted every single ounce of tax-advantaged space available to you, do you finally earn the right to arrive at the last and final step. This final frontier, Phase 7, is the taxable brokerage account. Ironically and tragically, this is exactly where almost every amateur investor desperately wants to start their journey. Taxable accounts are the absolute Wild West of the financial system. There are no government contribution limits holding you back. There are no frustrating withdrawal penalties based on your biological age. You can buy highly volatile individual stocks, you can trade complex derivative options, you can speculate heavily on commodities, or you can just steadily buy standard, reliable index funds. You possess ultimate, unrestricted flexibility. If you want to buy a massive house in 5 years, the taxable account holds your down payment. If you want to rebel against the system and retire a full decade early, long before the government legally allows you to touch your retirement accounts without severe penalty, the taxable account acts as your vital financial bridge to early freedom. However, with this immense, intoxicating freedom comes a severe, mathematically guaranteed drag on your performance. I am talking about taxes. In a standard taxable account, every single time a company in your portfolio pays you a dividend, the government aggressively steps in and takes a slice of your cash. Every single time your portfolio manager rebalances the fund and sells a stock for a profit, you get hit instantly with capital gains taxes. It is the exact mathematical equivalent of trying to run an ultramarathon while someone is constantly, relentlessly shoveling heavy sand into your running shoes. You can still technically finish the race, but your overall speed is severely compromised and it will require massively more effort. Let us look closely at the terrifying math of tax drag. If you invest exactly $10,000 annually for 30 consecutive years in a tax-sheltered account earning a steady 7%, you could end up with nearly $1 million in capital. If you do the exact same identical thing in a taxable account, losing a seemingly small percentage each year to dividend taxes and capital gains, you might end up with hundreds of thousands of dollars less. That is the silent, invisible killer that destroys amateur investors. But, and this is a massive but, taxable accounts possess one incredible, almost unbelievable feature for those specifically looking to build multi-generational wealth. When you eventually pass away and leave a massive taxable account to your children or heirs, those assets receive what the Internal Revenue Service calls a step up in basis. This is a monumental loophole. This means if you bought a specific stock at $10 a share decades ago and it is worth $1,000 a share on the day you die, your heirs legally inherit it at the $1,000 value. The entire $990 of compounding growth is entirely wiped clean of all capital gains taxes forever. It is the ultimate, final, permanent victory over the tax code. In conclusion, the great secret to wealth is not finding a magic stock that goes up 1,000% in a single month. True, lasting wealth is established by mastering the unsexy, boring sequence of operations. Build the psychological safety net. Eradicate the cancer of high-interest debt. Extract every penny of free money from your employer. Optimize your individual tax shelters. Weaponize your health savings account. Maximize the corporate limits. And finally, deploy your excess capital into taxable flexibility. When you follow this exact, precise mathematical path, you completely remove the flaw of human emotion from investing. You stop guessing, you stop gambling, and you start executing like a machine. You transform from someone who blindly hopes to have money into someone who mathematically guarantees their own ultimate financial independence. Most people will completely ignore this advice because it requires extreme patience and relentless discipline. But you are not most people. You are building an empire, and empires are built one perfectly placed, unshakable stone at a time. Thank you for joining me on this extreme deep dive into the absolute financial order of operations. If this masterclass shattered your previous illusions and gave you a crystal clear blueprint for your future, make sure to leave a comment below right now telling me exactly which step you are currently conquering. Do not forget to subscribe to Fingraphy for more elite, mathematically sound financial strategies. Keep your mindset bold, keep your strategy precise, and I will see you in the next deep dive analysis.